If you go back to before the COVID, what you see is we have lost considerable strength in the economy. We have fewer people working, and we have a reduced stream of goods and services, and yet the price is much higher. So if you believe in market efficiency, which is wrong? Was it wrong before, or is it wrong now? But is it really justified that we have delivered a serious wound to the global economy and the global stock market has gone way up? It doesn't feel right. I think we all know that. This is a monetary game, and you can keep these little monetary bubbles going for just so long as you keep confidence rising. But when confidence has reached these levels, the history books are pretty clear. It's very difficult to increase your enthusiasm from a state of mild hysteria where we are today. You know, I've been around to see a 16% 30-year bond, and I now see it, whatever it is, 2.5. And we've seen real rates in 2000, real rates on the tips was 4.1, 4.2, real guaranteed forever, and now they're nothing. Of course, they're negative. And they're negative all over the world. And what you're doing, therefore, is you're saying, we've got an artificial interest rate structure, clearly artificial, that has been driven down all over the world into negative territory. 20% of government bonds have a negative real return. And we're going to use that as a yardstick. We're going to say stocks are cheap because they are less utterly ludicrous than a 30-year bond or cash, which is deeply negative. This is not typically the way you measure things, by taking a ludicrously mispriced comparison. And that's what we're doing. It makes people feel happy. It doesn't make me feel happy. I suspect selling everything would work out just fine. However, having said that, there are major discrepancies, as there were in 2000, between the US tech, which is overpriced the same as it was in 2000, and everything else. So the value stocks, the low growth stocks, if you prefer it, are about as cheap relative to the high growth stocks as they ever get. So they will not have the same pain, but they're still at risk to some degree, I suspect. The good news is that overseas, they have not had this same huge bull market and the same overpricing that we have had. And that of course, is a heaven-sent opportunity, because you can go out into the emerging markets, and they are absolutely not that expensive, despite the ridiculous argument of comparisons with a overpriced bond market. They're simply not that bad anyway. And compared to the S&P, they're as cheap as they have ever been, about. They've been this cheap 2 or 3 times, and each time it's worked out very well. So you can buy emerging markets, and you can look at the intersection of those two ideas, which is the low growth stocks or the value stocks within emerging, and they are handsomely priced. You should be able to make a really decent 10, 20-year return there. You will not make a handsome 10 or 20-year return from US growth stocks. There is, in the end, a simple arithmetic. The higher you bid up the price of an asset, the lower the long-term return you will get. There is nothing you can do to change that equation. Every day the market goes higher, you know only one thing with certainty, that the long-term return will be less than it was the day before. What happens if that happens? Then there'll be a lot of sad value managers. Now, the question is, will it happen? And it would be historically unprecedented were that to happen. I'm pretty certain it will not. However, having said that, let me say one thing about value. I have no confidence, and have not had any for over 20 years, in price to book and PE and price to cash flow, price to sales, even as a measure of true value. A measure of true value is the long-term discounted value of the future stream of dividends. A growth stock is of course worth a higher ratio of this, that, and the other than a low growth stock. but that doesn't mean they can't be overpriced. So value should be cheap for what you are. You should build in the growth, you should build in the quality, and if it's overpriced, it's overpriced. But to use a simple-minded measure of book is a crazy idea. A cheap book is the market's vote on the worst assets out there in the marketplace. The lowest PE is the market's vote on the worst earnings, most likely to be overstated or downgraded. And the same with yield. It's the market's vote of the most likely to be cut. These have no business being a good indicator of future performance. I'm also worried, by the way, about inflation. If you think you live in a world where output doesn't matter and you can just create paper, sooner or later you're going to do the impossible, and that is bring back inflation, that we haven't seen for 20 years. And you keep it up on a global basis, you will have inflation. And I can't help but notice that around the world, the commodity prices of all kinds really, but particularly critical food and critical metals are going up. And if you have that happening and you have a rapidly declining growth rate in the workforce towards zero and negative, you are really set up for this time is different. So we are not just in a bubble market, but we're looking at a global economy that is at an inflection point to turn down in long-term growth rate. So this is a bad time to be caught over speculating. First of all, very difficult. And secondly, of course, diversify. It's always a huge advantage. And thirdly, amazingly, the low growth stocks in the emerging market world are perfectly reasonable. If you need to own stocks, and most people do, that would be a perfectly good way to go. And I also think shares that benefit from the greening of the economy will do much better than the rest. Anything to do with renewable energy, the electrification of the system, electric cars, etc. These are all going to have top-line revenues that dwarf the declining growth rate of the rest of the global economy. It will take trillions of dollars to decarbonize the global system. It will dominate everyone's portfolio. And if you have to own US stocks, they're the ones to own. And look around for a good climate change fund. I'm happy to say GMO has one. And they're doing very well now that the focus is clearly, finally, took 20 years to wake up, but in the last year, people really are beginning to understand the size of the problem and the need to move money into greening the economy. What is the future value of the dividend stream of Bitcoin? I can tell you that doesn't take a prize-winning mathematician. It is nil. It will never pay you a dividend. If you're desperate, can you eat it? No, you can't. Its entire value is on the greater fool, is it not? So Bitcoin could be worth $1 million a unit if you can find someone to pay it. That should give you a measure of restraint in your enthusiasm for gold, granted. But gold has had the odd 12,000 year test, which it has passed pretty well. And Bitcoin has got a few years to go yet to catch up. And secondly, gold does have some fallback qualities. It doesn't tarnish. It's unique in that sense. Everything that was ever made of gold is still around. And that's a pretty handy characteristic that Bitcoin also lacks. So I would say, yes, I'm nervous about gold because I can't eat it and because it pays no dividend, but it has two wicked advantages over Bitcoin. Bitcoin is 100% faith. And come the next market phase where faith is at a minimum, what do we think will happen to a stock whose entire reason for existence is faith and nothing but faith? It makes no commercial sense at all for them to attempt to warn the clients of impending doom, ever. It is terrible business to blow the whistle on a major bull market if you're a commercial enterprise. You make your money by having the bubble keep going. If you have the market double, 3 or 4% of that gets spent and helps the economy. He was right, and he bragged about it. And then following him, Bernanke bragged about it, that they had contributed to the health of the economy, and they had. And now the Fed also brags that it has done its part and it's helped encourage the economy through high asset prices. All of it's true. The bad news, however, is we live in a world that is, in the end, a real world of people and production. And in the end, therefore, despite Alan Greenspan's enormous willingness to create a new permanent golden era of productivity, et cetera, the S&P still came down 50%. The NASDAQ still burst and went down 82%, despite his fanatical interest in moral hazards and helping out stock market prices. The point is, they did not brag of the negative effect of the market mean reverting back to normal. It comes in at just the time you don't need it, and it sucks out of the economy a negative wealth effect, and as it will this time. SPACs should be a completely illegitimate instrument. They're just an excuse for people with reputation and marginal ethics to raise a lot of money, take 20% of it for themselves for a quick dash around the country for 6 months. And a complete ripoff in the sense that the professional hedge funds then always liquidate before taking any real risk and take the premium that they can get and a few warrants, leaving the half of the marketplace that retains it, who put their money up, on aggregate with a very bad return. Of course, they'll make some money in the late stages of a bubble, but if you look at the first 6 years, they have a handsomely sub-average return for taking all the risk. No, they don't have enough legal requirements, enough restraints, enough checking. They're a thoroughly reprehensible instrument, in my opinion, and should be disallowed.